Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Ackman Ziff Real Estate Group, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Gemini Real Estate Advisors LLC, Genova, Burns and Giantomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Site Comply, Sterling and Sterling, Stephen Napolitano, The Wickoff Group, Urban American.
Every 48.7 million people came to New York City last year. Where do they stay? They got to stay at hotels. So they want to stay at the best hotels or the most reasonable hotels or a hotel where you can get a lot of opportunities. So I brought the people who run, operate, manage, finance hotels today to my group. My guests today include Larry Corman, who's the co-president of Corman Communities and president of AKA. Navim Kakarla, who is the president and CEO of Hersha Hospitality Management. Kevin Coquette, who is vice president of acquisitions at Starwood Capital Group. And last but not least, my good friend, my returnee, Will Abide, who is the president and CEO of Gemini Real Estate Advisors. So, king of the select service, tell me what's going on. Tell me what the market's like.
Business is good. Business is good. Going into 2011, January and February were definitely a little soft. We were a little worried. And then as soon as March came around, we started to really hit our stride. And in April was fantastic. And May turned out to be a great month. Right now, we're probably up 15, 16% over last year. We expect that to continue for the remainder of the year. I think the big changes have been, number one, a lot of the new supply that came online in 2010 has been absorbed already, so that's good. And number two, I think that the favorable currency, that is the weak dollar, strong euro, is also helping with foreign travelers.
I agree, but I think we were talking before, we're still seeing a lot of domestic travelers coming to New York.
Yeah.
Well, the 48.7 million weren't only foreign people. People want to come to the Big Apple. People want to be here. I know Navim is managing hotels in Lower Manhattan. They're doing great, right?
They're doing great. You know, what we've seen so far is it reminds me of prior years in that the first few months have been spotty, but then we've really picked up stride. As soon as we've hit Easter in every prior year, we've really hit a new pace of bookings. What's interesting about this year is that the booking window for us is still very, very short. And to your point, the business transient travel has come back in a big way, and we saw that last year. We're a little bit less reliant on groups, but it seems like the large group boxes have planned better for this year, and I think they've done a better job of shifting their mix.
You know, there was an interesting thing that I caught, I think, on STR, Smith Travel Research for my audience, that Expedia and Groupon are doing a deal together. I mean, what do you think of these Expedia Groupon effects on your hotels?
We don't touch them. We do everything ourselves and wait for the business to come to us. We don't rely on using those third-party mechanisms. Our first quarter also was very strong compared to last year, up about 30%. This year, I think 2009 was the low point of that.
It's really interesting because I have, Will, who really has some great select service properties, and I have Larry over here, who has a very unique, many of them extended stay, long-term, larger suites. And you were saying before that in one of your properties, you rented out a lot of the rooms to the people from the new Men on Black.
We purchase condominiums and then add the refinements to design, the boutique hotel services that people are looking for. But we're really catering to somebody looking to fly under the radar, somebody seeking anonymity, a longer length stay. And the movie production companies replaced a lot of that travel that you said had come from Europe and overseas in 2008, where the dollar was weak. So the entertainment groups, individuals who are in transition, seeking a more space, some of the luxury refinements they would get at a traditional high-end hotel.
So what's the size of your room? And I think it's important because we have different type of people. Plus, we have the guy who invests and also lends over here. So
they're full-size apartments. We purchase condominiums, so it's a full kitchen, a full living room, a full bedroom, king-size bed, glass showers, all the luxury appointments.
It's not like my friend over here, Naveem, who's right across the street from the studio. I still remember walking into that 145 square foot Hotel 373, that you're lucky that you can get in. But but you have all different sizes.
We do. Our hotels range from Hotel 373, which is really a rooms-focused operation, a very minimalist lobby, but its strength is the European and international traveler because it's catty-corner to the Empire State Building, as we are sitting here today. On the other hand, when you're looking at the Hilton Garden Inn, by contrast, and you're comparing some of our independent hotels, you're getting into the 230 to 280 square foot range. And what's interesting is just as we build each new hotel or as we redevelop each new hotel, the way that designers are able to use space is really something to watch.
I think
it's unbelievable.
Part of that, and I think when I went to visit the gym a couple of months ago, we were there with an investor. Could have been you too, but we were there visiting, and we had seen, the efficiency that you can make in a room. I mean, fortunately, you have the flat screens over there, the beds which are, utilized into different cases. We're not looking at that luxury. You're in a certain category. You're the money man. You're the guy who has an opportunity fund, so you want to buy hotels and you want to lend on hotels. So tell us what you like.
Yeah, I think it really depends. There is times where, depending on the site, it makes sense to go with as small rooms as possible, where you're going to get more revenue per square foot and ultimately more profit if you have more rooms. There's other opportunities, I think, certain locations. We just bought a building on 6th Avenue and 58th Street with Central Park views. And there we believe that there is no real rate ceiling. We are competing with properties like Larry has, the Ritz-Carlton, the St. Regis, the Mandarin, kind of that upper tier of 4- and 5-star properties. In there, I think we could do a very successful execution with small rooms. I think on average, we want to be larger so that we can push that additional rate. And there are certain instances in New York City, and I think it's also important to note that New York is very unique in this sense, and there's many other markets of the United States where this is the exact opposite. But in New York, there's many instances where you will get more revenue per square foot in a suite than you will in an individual room. So just to use math, you have a 400 square foot room, you get $400 a night. You have another 400 square foot room, you get $400. You put them together, okay? In most other markets in the United States, suites are a giveaway. So the revenue per square foot, they're not getting $800 a night. And if they try to, it's going to be 30% occupancy.
We can put 12 people in their suite, forget the extra beds.
Yeah. It's
no
tough.
cots, no service.
It's tough to do. And that, in many ways, that's the Embassy Suites model. But so I think it largely depends. But New York is unique in the sense that there are certain opportunities where you can have that larger room and not get 800, but get 1,200. So you're actually
and a lot of
getting
it's
premium.
based on location.
So here's an interesting question. All of you can constantly look for new sites and new locations and everything. What do you think the best new location or the best location, I don't want to use one, what are the best locations that you want to be in? I mean, the two of you have great sites. Union Square, I think it's fantastic. You walk around Union Square, you cannot believe how it changed over the years. I mean, you walk in, you got the Nordstrom's rack, you got every shopping, you got, the thing that's lacking in Union Square is restaurants.
ABC Kitchen.
But that's one restaurant, and you have all those people over there.
Union Square is a very exciting market. We're very happy to be developing a hotel in that marketplace.
You'll be competing with him, but both of you will survive very well, I'm positive.
There's enough of that market to go around, but it's a very dynamic market. There's a lot of demand, both business and leisure travelers that want to stay right in Union Square. So we're pretty pleased.
What do you think of the Bowery?
Bowery's another great market. I think you have to be a little careful. I don't think there's as much demand as there is in the Union Square area, but that's another good market.
I think that's an interesting. What do you, as a lender and as an owner, what do you think of the Bowery?
Yeah, I mean, I think at the end of the day, it all comes down to basis. Our theory about New York City, Manhattan proper, is that the occupancy is going to be there. It's really a function of rate, and you want to capture as much of the premium business as possible. I think, as Will said, that the Bowery is incredibly compelling for a certain type of consumer, and that consumer is traditionally going to pay more on weekends, versus some other locations like the financial district where there are going to be much more higher rated business during the week, and they're going to have to discount on weekends.
But isn't that a little different? I think the financial district today, you have a lot of people traveling. They want to go down to Ground Zero. There's a lot of people going there on the weekend. So what happens is you have the business travelers during the week, and then on the weekend you have a different customer base, right?
The financial district is a great submarket in New York, and I'm very bullish on it. I think it was just this week that UBS, I believe, announced that they're going to relocate from
UBS said that they're looking to possibly move
lower
to three
Manhattan.
times.
But generally, just looking at all of the planned development and some of the starts that are in place, I think it'll be a very dynamic market. I think Wall Street has held up much better than people expected. I think that what Seaport has done and the diversity of experiences down there has really grown. I mean, I believe that Ground Zero is the second most visited site in Manhattan today. And what's missing there are restaurants and a lot of retail. What was missing there? Now we have retail. I think you need a little bit more in terms of nightlife and restaurants.
What about you? Do you think? Have
We
you
have
ever
four
thought of Tribeca?
Well, our 4 properties in New York City are all Midtown Manhattan, so we would like to add, as part of the synergy to our total portfolio, in Tribeca, Soho, in addition to other markets that are complementary to New York, which is our base, which is London and Los Angeles. So we are looking very strong at those markets, and the capital markets have opened.
You know,
up
there
where
are 5 boroughs in New York. We're talking Manhattan. What about the other boroughs? I mean, have you looked in Brooklyn?
We've looked in multiple areas. I mean, I think that we are particularly bullish today about New York City, and one of the reasons is the rest of the market is just picking up this year. New York City was on fire last year. It picked up huge RevPAR gains. So the fact that we're seeing big RevPAR gains on top of RevPAR gains is great news. A lot of the rest of the country is just picking up now, and we're still very bullish on it. I would put the boroughs more and compare, at least in terms of the rate potential, to many other areas in the country.
Naveem, you have 2 hotels in Brooklyn, right? You have the New.
We have 1 hotel in Brooklyn.
One hotel, the New, which is a great, it's right on the Brooklyn Heights neighborhood. It's in the middle over there.
Yep, New Hotel's at Smith and Atlantic, and it's a very dynamic market because Smith Street has become Restaurant Row. What's interesting is we've had a lot of new supply on the branded side, but fortunately nothing on the independent lifestyle side. And so we've been able to really maintain our rate, which we took as a strategy in the face of new supply. And Brooklyn has been more resilient than people would expect in terms of occupancy.
Now, I know that Jed Relentis, with bond money and some other things and a lot of personal guarantees, is building in Williamsburg. Have any of you looked at the Williamsburg?
We've looked at Williamsburg a couple of times, and in the end, I could never get comfortable that there was sustainable demand for that submarket. There's obviously a lot of new gentrified residential projects that have gone in there, but I feel that when folks come to New York, their first choice is always going to be Manhattan, and Williamsburg is going to be a little bit of a tough sell.
Very interesting. I was doing research for one of my articles, and I wanted to show, that hotels are being sold for $435,000 a key, and then I caught this thing because I read all the time that there was a Holiday Inn in Staten Island, which closed for about 2 years, and it was recently sold to an assisted living operator, and they paid $7,000 a key. Wow. I mean, needless to say, it needs a lot of work, but I think it gives you the example of what Will was just saying. Certain sections, Staten Island is really, people say, when they come to visit New York, I want to go to Brooklyn, or maybe I want to go to Flushing, like we were talking. Nobody says I'm running to Staten Island or the Bronx. It's not the right situation. What about, in Newark right now, they're building a courtyard. They haven't had a new hotel in Newark in 40 years. Any idea about the New Jersey suburban market, Newark?
I have heard that the Harrison submarket outside Newark has done very well, and I believe there's a select serve hotel that's done dynamite. But what's
right near the Red Bull Stadium, probably.
Right near the Red Bull Stadium, right where they're redeveloping the water area, I believe. What's interesting about Harrison and in some ways Brooklyn, but certainly Williamsburg and Staten Island, is that you just don't have the multiple demand generators. You can make money if your basis is low and if you can build inexpensively. But if you expect New York to get back to 08 levels in 12, let's say, you would get back to 06 levels in 12 in those markets. And so there are opportunities to build new hotels. I don't see enough new demand generators to suggest overpaying or being aggressive in those markets.
Here's a question. Yeah, Larry.
We have a property 3 miles from Newark in Union under our AV portfolio, and it's done very, very well this year compared to last year. And I think Ironbound's another area near Newark that started to step up.
Ironbound is a different type of section. I mean, the new hotel that's being built in Newark is, it's getting a lot of tax credits and other incentives over there. It's right next to the arena. And the only other property in Newark right over there is the Hilton, which is many years old, needs a lot of work. But there's a Robert Treat Hotel. It's the Berger family's owned for years, and they've done well in that situation. What about banks? I mean, you're a lender, you're a bank in certain ways. What about traditional banks, Will? I mean, what are you seeing with lenders today? Are they back to lending on hotels?
The good news is that the lenders have set unbelievably aggressive targets for what they're going to put out this year. And they're talking about doubling the amount of invested capital in 11 versus 10 in some cases. And often they're talking about the resurgence of CMBS, and some players who were not in CMBS in the first cycle are coming in. And at the same time, you have a lot of hedge funds and private equity firms that are competing for the same loans that we would have gone to traditional banks for. The bad news is you have this unbelievable separation where you have cash flowing hotels that are established who are able to go out and get very unbelievably attractive financing. No one would have predicted it 3 years ago, that you could get the kind of financing that we can in our New York hotels. On the other hand, the people who really need the money are not able to get SBA loans in the smaller hotel instance or private banks who, I still believe and hope that the second half of this year will be defined by a lot of private banks stepping up and allowing for 65, maybe 70% loans with more reasonable overall terms, but it just hasn't happened yet.
I think you're right on the mark, because Will knows I get together with like 40 bankers every quarter. We have this big dinner, and for the luxury hotel, for the established hotel, there's a hotel, I don't want to mention the one, on the west side, great location, good brand, and Wells Fargo came to the plate with $250 million at 225 over LIBOR. And the other banks are sitting there and saying, we wanted it, but we don't want to do it at this price. And so, it's a tale of two cities. And I think, it's truly a tale of two cities in that situation.
I think hotels are very financeable right now. Follow up what Naveen had alluded to. We've closed 3 loans in the last year and a half on hotels, and the terms have just gotten better and better. I think right now, generally speaking, for a cash flowing hotel, you can get a loan at approximately a 9% debt yield. So NOI over the total loan balance.
These are established hotels. So now here's my question. There are certain sites still available that you can build from scratch, how many, I mean, would you, on your debt hat, since you have, you have two heads over here, on your debt hat, would you lend on a to-be-built hotel?
So we're structured as a mortgage REIT. And for us, lending against cash flowing hotels is very important. Ultimately, we pay a dividend. There are certain instances where we will lend against either pure development sites that are going to be built hotels or redevelopments. The issue for us is we're ultimately mezzanine lenders. We're whole loan lenders where we keep the mezzanine position and then sell off the A note. And when there isn't cash flow up to date, it's been very hard to do that.
You don't have the sources.
The CMBS markets are all about cash flow. And until the more traditional banks, such as Wells Fargo, come in an aggressive way and are willing to take a 0 to 60% loan-to-value construction loan, or they'll just ultimately make the construction loan themselves, I think it's still going to be few and far between.
What's it cost today to build a select service or a little higher level hotel per room?
Per room, call it $400,000 a key.
About $1,200 a square foot.
$1,200 a square foot, you think?
I think it depends in New York City on the land basis. And even since we started looking at, and we've acquired, I think, 4 sites that we're going to be developing as hotels.
So you have 14.
Yep. A few of them haven't been announced yet, so I apologize.
No problem. No problem.
We're very active in New York City, and I think one of the
For
things
development also.
for development, where we're financing, and in certain cases, we're actually going to be doing the development.
Now, a number of years ago when I did a couple of shows and we were talking about, it's like Larry was talking before, he doesn't like Expedia, which I think many of the people who I know prefer not to deal with Expedia or, hot
You get a lower end
hotels
clientele, you pay an
right,
exorbitant.
the idea is, how important is a flag today? Having a national flag or situation.
I'm going to answer that quickly from 2 different hats. Lender's hat. Lenders in general prefer flags because flags equal safety. From an opportunity fund standpoint, it's all about risk reward. And I think many times there's more reward if you go independent.
I mean, if you look at, Larry created the AKA brand. Will created the Gem brand. So these were not brands who were out there, and like the new hotel is a boutique brand. It's not part of it. And it's been very successful in that manner. And then there's Vijay Dattapani, who is the Apple Corps, who really has no brand. So I understand the banking point of view, but certain people say, if I get that brand, I have to pay the extra 3%, the marketing expense, the other thing, and I'm really not getting anything out of it.
You also have to consider the size of the hotel that you're looking to build. A 100-key hotel, you might not think you need a big brand.
I think with all this group, I better be able to get some hotel discounts.
I think a little less about the fee to the brand, and I think a lot more about just flexibility. You certainly have flexibility.
I think it's the flexibility.
You certainly have flexibility around construction standards, but frankly, you need to meet the requirements of the consumer anyway. And so if you're going to do that and you're going to get it right, I think where we have flexibility is in terms of how we set rates and how we're perceived relative to an overall brand system. If you focused on New York for a second, I have less of a rate ceiling and the ability to create a product that meets a customer preference within our independent hotels. So we run 12 independent hotels, probably run another 65 branded hotels. And so both work, but I think where you have a market like New York, what's interesting is if you look at the last cycle, our independent hotels fell before our branded hotels and they came back first. Mm-hmm. And now in a recovery where you're really trying to push rate and drive margins, I believe whether we went through brand.com or our own website or started using third-party channels, we actually have a better ability to drive rate. And we're viewed more independent.
So here's a question, and I remember I did a restaurant show and I'm doing one next week, and we were talking about the Palm, who created the 347, the club, basically based on the 825 Third Avenue, the club idea, and people would get the club, they'd have a card, they'd get the emails of that situation of different alternatives. Do you think having your own club, your own brand, the Hersha brand or the Corman brand or the Gem brand, where people feel that they're getting something that helps also?
Loyalty programs?
It's a loyalty program, but a specific loyalty program to a brand that you've created.
Exclusivity,
Exclusive.
part of something special.
I think there's a lot of value to that. I think it's very difficult to execute on in those brands that do achieve that sort of exclusivity and have a loyalty program that's effective, works extremely, extremely well.
I think beyond just the brand itself is what the brand stands for. So the expense associated with a FITA brand is secondary to the way in which a brand operates. So the Four Seasons may have 250 people working, where our concept and the way in which we operate is based on operating more with the revenues of a hotel and the expenses of an apartment. So we're not as risky, we're not perceived as risky to a lender, and we don't operate at the same threshold or operating expense of a 4-star, 5-star hotel. So I think beyond the brand is what that means. The secondary point of the brand is you do create an image or perception of the way in which you're going to live. If there's a small lobby, intimate lobby, and large spacious suites, that is conveyed in a brand.
Some of the business travelers want to go to a hotel that's managed by Hersha, or they know that Hersha is going to provide something, or people know that it's a Corman. Even though it's not a world-renowned brand, they know because people have said, I've been there. It's like that special independent hotel, the STR, the small independent hotel, that their situation. I wish we had more time to talk, but 30 minutes have passed. So I'd like to thank Larry, Naveem, Kevin, and Will, and I'll see you next week.
Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Ackman Ziff Real Estate Group, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Site Comply, Sterling & Sterling, Stephen Napolitano, The Wickoff Group, Urban American.